The United States recently imposed a 50% tariff on steel and aluminum from Canada, prompting a series of strong retaliatory measures from Ottawa, including flexible tariffs and a sweeping overhaul of supply chains. Who stands to lose the most in this intensifying trade dispute? In June 2025, the Trump administration implemented a 50% import tariff on Canadian steel and aluminum, citing national security and trade imbalance concerns. While the move was framed as a strategic step to revitalize U.S. manufacturing, its application to a long-standing ally under the USMCA stirred significant backlash. On June 19, Canadian Prime Minister Mark Carney announced a 25% retaliatory tariff on U.S. metal products. Crucially, the policy includes a dynamic mechanism. If no progress is made in negotiations by July 21, the tariff will automatically increase proportionally. This is Canada's first deployment of an open tariff, an innovative approach intended to apply both pressure and leverage while leaving the door open for diplomacy. Canadian officials emphasize that this move aims not at escalation, but at asserting economic sovereignty and defending domestic jobs. According to Canada's Ministry of Industry, over 34,000 jobs in the steel and aluminum sectors are directly threatened by the U.S. tariff action. In addition to hundreds of small and medium-sized manufacturers at risk of shutdowns. At the same time, the U.S. government has remained largely non-committal. Industry stakeholders in both countries are watching closely as tensions mount, with Canada signaling that further retaliatory measures could include regulatory hurdles, port inspections, and non-tariff barriers targeting U.S. goods. The deployment of tariffs by both governments signifies a new, more volatile chapter in North American trade relations. As post-pandemic recovery efforts remain fragile and geopolitical uncertainties persist, the cascading effects of such trade policy shifts are being felt beyond industry, stretching into retail, logistics, labor markets, and consumer confidence. In tandem with its retaliatory strategy, Canada unveiled measures to promote domestic procurement and insulate critical industries. Beginning June 30, 2025, all federally funded projects, including infrastructure, automotive, and defense, must prioritize Canadian-made steel and aluminum, or source from countries with free trade agreements. Federal contracts will be awarded exclusively to compliant suppliers, ensuring procurement dollars stay within aligned markets. Additionally, Canada reaffirmed its dynamic tariff policy. If U.S. negotiations stall past July 21, the 25% duty will rise, establishing clear economic consequences for policy inertia. These measures are designed to incentivize U.S. companies to either localize production in Canada or form partnerships with Canadian firms. That shift would represent a structural evolution of the supply chain landscape across North America. New compliance mandates, including origin audits, import caps, and licensing reforms, require U.S. exporters to retool operations. Many firms will face mounting costs just to remain eligible in the Canadian market. For some, the investment required may not be viable, risking withdrawal from a key export destination. Canadian officials argue that these changes are not only about short-term leverage, but about reinforcing national resilience in the face of economic disruption. By reducing dependency on U.S. imports, Canada aims to build a more autonomous industrial ecosystem, one better positioned to absorb external shocks in future trade conflicts or crises. Meanwhile, the downstream effects are starting to show. In the U.S., costs are already being passed down the supply chain. Cars, home appliances, and construction materials may soon carry price tags inflated by compliance costs, logistical reconfigurations, and raw material surcharges. The repercussions of Canada's trade retaliation are reverberating through key U.S. manufacturing states like Michigan, Ohio, and Texas. In June 2025, spot prices for hot-rolled steel spiked, especially in Cleveland, as firms scrambled to secure supply ahead of a potential July tariff increase. According to the American Iron and Steel Institute, prices reached their highest levels in over a year, driven by speculative buying and supply hoarding. This preemptive buildup reflects deep concern among manufacturers about long-term availability. Producers dependent on Canadian materials are now re-evaluating sourcing strategies, with some turning to more expensive or logistically complex suppliers in Asia or Europe, further inflating costs. In a policy brief, the Bank of Canada estimated that 75% of additional tariff burdens will be passed on to U.S. consumers within 12 to 18 months. That projection portends price hikes for automobiles, appliances, industrial equipment, and even residential construction, heightening the financial stress on American households amid an already difficult inflationary environment. The ripple effects extend to the labor market. Manufacturers and suppliers are warning of job cuts or production delays as operating margins shrink. The National Association of Manufacturers is actively lobbying the administration to consider exemptions for small businesses or essential sectors, or at minimum to resume dialogue with Ottawa. Analysts caution that persistent uncertainty may depress regional investment. Some firms are delaying capital expenditures, wary of being locked into disadvantageous sourcing arrangements or multi-year contracts exposed to future policy shifts. Others are exploring automation and relocation options to offset labor and material costs. The trade conflict between the United States and Canada has evolved into a high-stakes standoff with tangible economic fallout, from Washington's 50% tariff to Ottawa's retaliatory framework and procurement overhaul. The consequences are spreading through steel markets, industrial supply chains, and household balance sheets. What once functioned as a pillar of North American economic integration now stands strained by policy divergence and strategic competition. As the calendar inches toward July 21, the prospect of resolution or escalation will shape not only cross-border trade, but the trajectory of economic resilience for both nations. Former President Trump's new steel tariff has ignited a major shift in North American trade and defense relations. Could this be the beginning of a global supply chain realignment? On June 4, 2025, former U.S. President Donald Trump enacted a significant increase in tariffs on imported steel and aluminum, raising them from 25% to 50% via executive order. This move, aimed at bolstering domestic industries, particularly impacts Canada, the U.S.'s largest supplier of these metals. Canada supplies nearly half of U.S. aluminum imports and a substantial portion of steel, making it a critical partner in sectors like defense, automotive, and aerospace. The tariff hike has disrupted the integrated supply chains between the U.S. and Canada. American manufacturers, especially in the Midwest, are facing material shortages and increased costs. Industries dependent on Canadian metals are experiencing production delays, leading to potential job losses and higher consumer prices. Economists warn that the increased costs for raw materials are expected to hurt manufacturers and consumers by raising prices on a wide range of goods, from engines to beverage cans. In response to the U.S. tariffs, Canadian Prime Minister Mark Carney announced a strategic shift in foreign policy, emphasizing stronger ties with Europe. Canada has committed to joining the European Union's Readiness 2030 defense initiative, aiming to enhance military capabilities and reduce reliance on U.S. defense systems. Additionally, Canada is re-evaluating its trade relationships, seeking to diversify its export markets and lessen economic dependence on the U.S. The U.S. risks losing not just a key trade partner, but also one of its closest defense allies. Canada's alignment with European defense and economic structures could diminish U.S. influence in North America and open opportunities for other global powers to strengthen ties with Canada. This realignment may lead to reduced access to Canadian resources and markets for American businesses, potentially impacting sectors ranging from energy to agriculture. The sudden tariff increase has sent shockwaves through U.S. industries reliant on Canadian metals. Manufacturers in states like Michigan, Ohio, and Missouri are reporting immediate challenges, including halted production lines and financial losses. Despite warnings from industry experts about the potential fallout, the tariffs were implemented without a comprehensive legal framework, leading to confusion and uncertainty. The disruption in supply chains is expected to have long-term economic consequences. Businesses may face prolonged recovery periods, increased operational costs, and the need to find alternative suppliers, which could result in higher prices for consumers and potential job cuts in affected industries. For instance, U.S. manufacturers currently meet only about 20% of domestic transformer demand, creating a critical dependency on imports. Lead times have expanded from weeks to 80 to 120 weeks for some equipment, causing project delays of 1 to 2 years in some cases. The U.S. just imposed the highest steel and aluminum tariffs since World War II, triggering a trade war with global consequences. What everyday changes will Americans notice first as these record-high tariffs ripple through prices, jobs, and even the electricity powering their homes? On June 4, 2025, President Trump officially raised import tariffs on steel and aluminum to 50%, the highest rate since World War II. Citing national security concerns, all steel and aluminum products, except those from the UK, are now subject to this tariff. Major trade partners, Canada, the EU, and Mexico, are hit hardest. Aluminum prices have soared by 190% since 2020, and building a new house in the US now costs an estimated $11,000 more. Auto manufacturers and electronics makers are also under intense cost pressure. For millions of Americans, these sweeping tariffs mean higher prices across daily essentials. Car buyers face sticker shock as vehicle costs surge. Home buyers must pay thousands more for new homes. Even common products like canned food and beer are getting pricier. The overall cost of living is rising, directly squeezing household budgets and reducing purchasing power for average U.S. families. Canada supplies 60% of U.S. aluminum and 25% of its steel. Hours after the U.S. tariff announcement, Ontario threatened to tax electricity exports, powering over 1.5 million people in New York, Michigan, and Minnesota. Foreign Minister Melanie Joly confirmed federal contracts will now require domestic steel and aluminum. Canada also reimposed retaliatory tariffs worth 29.8 billion Canadian dollars on U.S. goods, warning of more unless the tariffs are reversed. For border states, Canada's response could bring major disruptions: electricity shortages, strained supply chains in construction, energy, and machinery, rising prices, project delays, and job impacts for countless Americans. U.S. companies are hurting. Ford and GM lost 3 to 4% of market value after the tariffs were signed. About 30 to 40% of U.S. auto parts rely on imported steel and aluminum. Craft brewers warn of 15 to 30% spikes in can and keg prices, threatening hundreds of small breweries. Consumers are bearing the cost. Car, beer, food, and renewable energy prices are rising, while wages stay flat. Families are struggling with mounting living expenses as price hikes spread across sectors, forcing tough choices. Gulf countries like the UAE and Bahrain are rerouting exports to Europe and India to avoid U.S. tariffs. UAE aluminum shipments to the U.S. quadrupled in March 2025 ahead of the new policy. Brazil and Turkey are boosting trade with Southeast Asia and Latin America. While Europe warns of a looming metal scrap shortage due to surging exports to the U.S., China has shifted aluminum exports from the U.S. to the EU. For Americans, the impact is significant. The U.S. is being sidelined from key global metal supply routes. Domestic manufacturers face higher material costs, risking production hikes, job losses, and a decline in U.S. influence over emerging trade alliances. This isolation could redefine America's global economic role for years.